So first of all, as we saw quite the turnaround from what we saw with the CPI numbers, how much of this bounce that we're seeing today is solely about earnings versus other factors?
I actually think it's about peak in CPI and PPI. It looks like we've, gotten the highest PPI final sales number on record, and the spread between PPI and CPI is the widest I've ever seen. I think it's 4 percentage points or more. And so, all in all, I think that would suggest that maybe now interest rates have finally baked in all of the inflation that we're going to see. Clearly, the front end of the curve, of course, is going to rise as the Fed tightens toward 3%. But that means maybe the 10-year peaks at around 270 or wherever, after it was about 280, and it's now starting to come back down. And that's really good news for the large caps, the mega caps that we're seeing rallying today.
The PPI data also noted within the product detail that a major factor in the March increase in prices was for processed goods for intermediate demand. The index for jet fuel, that jumped 23% particularly. If we begin to see some of these jet fuel prices start to come down, what alleviation do you believe that would get to the producer price side, and then additionally get passed through to consumers and alleviate some of those price pressures as well?
Yeah, that's it. I think that the key, you hit on something here, and that is the spread between PPI and CPI. What I have found is that spread, the higher PPI is relative to CPI, means that puts pressure on profit margins. Because if those producers can't pass that 11% along to consumers, which they'll be able to pass some, that's going to weigh on profits. And it turns out that the spread differential between PPI and CPI does tend to leave corporate profit margins by about 3 or 4 quarters. So this is now plunged, and we expect that while profit growth is going to rise, we think that perhaps toward the end of the year we could see pressure on margins as some of these higher costs are not going to be passed along.
Jack, we had a mixed bag yesterday from analysts in terms of whether or not CPI had actually peaked. What number is it that you're seeing that says we have seen the worst of it and better days are straight ahead?
Sure. I'm looking at a couple of factors. One is Cresset's model. We use copper versus gold as a great indicator of where the 10-year Treasury ought to be. And I'll tell you, copper gold was pushing for 270 for months. We finally got there, and copper gold is still at 270 now, with the 10-year at 272, suggests that, okay, perhaps at least we've hit a nice business cycle equilibrium there. The other side of it is really just demand destruction. The fact is these higher prices become victims of their own success. And that's different this time, because if you think about an inflation cycle, that tends to be fueled by people wanting to accelerate buying in anticipation of higher prices down the line. We are now seeing consumers actually pulling back on demand, expecting prices to fall in the coming months.
And I want to talk about the relationship between Treasury yields and the Fed. I mean, a lot of people obviously drawing comparisons about what happened in the 2008 financial crisis and then how the Fed tried to unwind there versus what we might see here in 2021. In your notes, you said to suggest the Fed didn't influence Treasury yields would be like asserting that Lycra plays no role in yoga. So why is that relationship important to keep in mind right now?
Well, we have to keep in mind that the Fed has bought a total of nearly $9 trillion of bonds, half of which 10-year Treasury notes. And so if you look at, for example, the relationship between earnings yield, which is just the reciprocal of the PE, and the 10-year BBB bond yield, historically before QE, those two yields were virtually on top of one another. Since QE, they've widened out to a point where it would imply that the Fed had really pushed down 10-year Treasury yields 2 full percentage points below where they ought to have traded, all other things being equal. That gap has now closed, or virtually closed, in the last couple months, and that suggests perhaps another reason why perhaps that the 10-year Treasury is now fully baked in all of this unwinding, even ahead of what the Fed is expected to do.
And so even with that expectation teed up, We've often looked at the financial sector and said that they're a beneficiary in a rising rate environment, but we've also started to get some earnings that have come in as well. JP Morgan kicking off on the bank side today. What have they said that really signals to you what we should expect perhaps throughout the rest of this earnings season?
Well, I mean, that's really part of the demand destruction view that we have. And the fact is, even before Russia's aggression, corporate bond spreads, I should say, the yield differential between treasuries and corporate bonds widened to a point where they kind of broke down or broke out, however you want to view it, suggesting that lenders were starting to get cautious with lower quality borrowers. That's not great news for the banks. They tend to obviously bank on credit. They also look at the yield, spread, play the spread of the yield curve. And here, higher rates are great, but really what banks want is a yield curve, a highly steep yield curve, where intermediate term rates are substantially higher than shorter term rates. And we all know, of course, 2s to 10s inverted, suggesting that there's no steepness in the yield curve. And that's not really good for net interest margins at the banks.
And as Jared mentioned earlier, we'll see Wells Fargo, Citi, Goldman Sachs, several others tomorrow. Yesterday, or rather, I guess it was this morning, Jamie Dimon was sounding pretty gloomy and saying the Fed needs to try to manage this economy and get to a soft landing, and then adding, if possible. It sounds as though you believe a soft landing is more than possible, is likely.
Well, this is the issue. We've got, still a number of rate hikes ahead of us, right? A couple of 50 basis point hikes potentially over the next couple months. But at the same time, we're seeing slowing already on economic activity. For example, prices paid for trucking activity has plunged. Shipping activity has plunged. So, anyone who's saying that this supply chain and we're overcapacity and everything's running crazy hasn't looked at the data in the last couple of weeks, because it really does appear, and I think we got a sense of it yesterday from AutoNation. They're saying, you know what? Consumers don't want to pay high prices for used cars. They're going to sit around and wait. And I think a lot of that has to do with the fact that consumer confidence, the University of Michigan study shows that confidence is at the lowest level today that it's been since the financial crisis. That says something.